David, welcome to the show.
Thanks very much, Owen. Pleased to be here.
I'm glad that we could make this happen, given that you're usually in Sydney. Turns out your Melbourne HQ is only a stone's throw from us, so really delighted to be here in person. I might start with a question about you. You've obviously got a very rich history in terms of your career. You've spent a lot of time in really senior roles in the investment industry here in Australia. You've got breadth of experience across multiple asset classes. It's really impressive. I'd like to cut through all of that and ask about your background and the way you invest. So not necessarily like professionally, we'll get to that in just a sec, but just how you think about it, how that may have evolved through time.
Sure. Well, I started in the industry last century, sort of at the start of the 1990s. And back then, it was a very different industry. It was really dominated by the big life insurance companies, the AMPs and the national mutuals. There was a lot of more basic product. There wasn't the proliferation of individual investments per asset class. It was very much about, do you want a capital guaranteed fund or a capital stable or a balanced fund, for example? And those types of investments still exist. But, now we have platforms that didn't exist where advisors and investors can choose from hundreds and hundreds, sometimes thousands of investments. So there's a huge amount of choice now, which is very different. And so for me, coming through that journey, it's been a huge change. And even if I think back to those times, there was just about every company that had more than 100 employees had their own superannuation fund with their name on it. And it's very different these days with the huge industry funds and probably only one or two corporate funds left.
Yeah.
So a very different environment, far more product, far more choice. And that is obviously much better for investors, but with choice comes sometimes complexity, and so that makes it hard for a lot of investors. Where do I go? So for me, it's very important whenever I think about investing. Firstly, what is the objective? What's the goal? And then how do I put together a portfolio of investments to meet that goal? And I think it's important to consider everything that you put in a portfolio has got to have a role. It's no good just throwing a whole range of similar assets together. You need to think about what each investment's role is in the portfolio and how it's going to add to the overall objective or goal. From there, you really need to think about risk appetite and risk capacity. Sounds boring, but they're different, and you need to test that. What is the capacity to take risk and what is the time horizon? And from there, it's about then building a diversified portfolio of really looking for quality assets and staying the course. I've certainly seen a whole lot of products come out, new and different, sometimes pretty out there investments. And it's very easy to be tempted by these things, and you've just got to come back to those same principles of, what is that actually going to do for my portfolio and how is it going to help me achieve the objective? So you really need to stay the course and be patient. And I think it's probably a bit of a well-trodden path now, but one of the most dangerous phrases in investments, I think, is this time is different. It usually isn't. And by being patient and really staying the course, that's often the keys to success.
Yeah, I really like that. And thank you for taking us on that journey. I can't remember where that phrase originates, but it is so powerful. And I think that's particularly prudent advice right now, particularly because we're going to talk about private credit, which, as we'll find out hopefully in just a moment from you, that it's a marketplace that has been around for a very long time, but it is definitely something that is on the investor zeitgeist. Like, it is what people are talking about, both financial advisors and end investors. We're all kind of looking for yield. We're looking for passive income. There's more retirees in Australia, and people are in search of income, particularly, as we record this in 2025, because a lot of equity markets have rallied and those types of things, the franking credits and all those types of things that people would historically rely on. They're now thinking, well, where else can I get my income? I don't want to be obviously lured into any gimmick or anything. And I don't want to take a lot of risk, but I want reliable income. So that's what this episode is all about. Let's start with big picture. Imagine you guys do, and you said this off air, which was very, I guess, concise the way you put it, is that there's a lot of complexity under the surface when people think about what happens in private credit. But ultimately, the outcome for investors is a very simple one. Can you take us on a bit of a journey with that, David, insofar as what is the market? Why is it interesting? Feel free to start wherever you want. Pull out whatever bits and pieces you have available off the top of your head. And I'll obviously have some follow-up questions.
Yeah, of course. Look, I think the real proliferation of private credit in portfolios started probably in the GFC, where you go back to 2008, we came perilously close to a full-on financial market collapse as we knew it. And as a response to that, regulators, central banks and governments were very determined that, hey, we need to build more buffers into the market. We can't have this happen again. I mean, counterparty risk was even something you study it in textbooks and you don't really think about it day to day. And then you have an event like the GFC and then counterparty risk becomes real. And that, I think, was something that really started to change the landscape. Much more regulation on banks in particular, which meant that they stepped away from doing a lot of lending that they'd traditionally done. And with that, there was an opportunity for other private pools of capital to come in and take up the mantle, if you like. The credit was still, fundamentally good. There's still a demand for credit, and that void needed to be filled. So that's where a lot of the private credit came in to, really fill the void from this, as we call it, debanking of the market, where the banks had stepped away. Corporates still needed to borrow to carry on business, and individual investors who were looking for credit as well. And so that opportunity really has arisen from there. And there's, a huge supply, as we know, of capital in the market. The industry super funds, for just as one example, but sovereign wealth funds as well, chasing, as you pointed out, Owen, income, but also solid total return. So if the credit is done well, it's an attractive part of the market. So hopefully that gives you a sense of where it started.
Yeah, and I think that's a particularly interesting answer because a lot of people would be familiar. I was just thinking about, we've read the books or we've seen the TV shows and we've studied history. I hope everyone that listens to this has studied at least some part of the GFC to understand like what can go wrong. But in that environment, we heard of CDOs. We saw some really funny things happening in terms of like credit ratings and those types of things, which is a particularly apt way to start this conversation. Maybe to give like a kind of crystallized example for people, when we talk about private credit here today, are we talking about really small loans? Like, are we saying, you're lending money to my small business, or are we talking about something bigger than that?
Well, it's really funny. Before I answer that question, it was, when I met my wife, she wanted to understand a bit more about, she's a primary school teacher. What can she do? There are some great books out there, and I gave her one of those books, and to her credit, she read it and did a lot of Googling, and she sort of came around to understanding a little bit more about investments, which was
Do you
really
remember what the book was?
Fun. It was the Big Short.
Oh, yeah,
was the
great.
book.
Yeah.
So it was it was quite.
It's a great story.
Yeah, look, it's a great story, and going back to my time at SocGen and TCW, we were certainly involved in a lot of those markets at the time. On the other side, picking up some really attractive deals that had become distressed, but that's another story. But in terms of the private credit, it's a huge universe. I mean, we, for example, at La Trobe have been in real estate private credit for over 70 years, and that is really about providing lending as a non-bank financier where we started to to individuals to buy homes. So that is one form of private credit. But there are many forms, and that's obviously our fundamental asset class. But there is corporate lending, and that can come in various forms to small businesses and to very large businesses. It can be as much as to provide finance to buy equipment for small businesses, or it can be large private equity buyouts of big listed companies. So it's a very broad range, and everything in between that's really not provided by the banks can fall into private credit. There's distressed lending is something that you'll also start to see a little more about as some companies and projects become under a little bit more stress. There are lenders that step in and provide that sort of credit. That's another form of private credit as well.
That's a big universe then. In terms of one of the questions that Mitchell and I wanted to ask you is, are there some misconceptions that you see about people's understanding of what it is when they think about investing into this market? Is there anything that you would want to clear up for people?
Look, I think it's probably what we were chatting about off air. I mean, essentially, you're extending loans to individuals, but more typically businesses, to carry on their business. And some of their businesses are funded by equity, but increasingly a large part of it is funded by credit. And that credit, particularly private credit, can be much more responsive to business needs. It can be done more quickly. It can be done on bespoke terms. And so that becomes quite attractive. But essentially, you're doing your due diligence, looking at the assets that you're lending against or the cash flows that you might be lending against, the strength of the security, pricing that and getting an income return from it. It's everything really stems from those basic concepts.
It's one of those things. I actually just remembered something, David. So with my business with Rask, we actually have a form of private credit now that I think about it. So obviously, like, there are shareholders in the business, myself being the controlling shareholder. But then recently we did a very, very small, by at least and definitely by your standards, like a very, very small private credit kind of like note where one of the shareholders lent us money to do something on like a short-term basis. Effectively, it was like 3 years, but that was the term, but effectively it's a lot shorter term than that. And so they would have like the shareholder updates for me as a private company and see like the financials and whatever and make an informed assessment of like, well, here you can have this X amount of money and this is the interest rate that I expect. And for me as a business owner, that's really good because I don't need to give up equity in order to fund that, like most venture capital type investors are looking for. So that was actually, as you were saying, that just stood out to me. One of the things that Trobe prides itself on is this idea of being the premier alternative asset manager, basically. Can you tell us what that means and what it means to you, but also to the business?
Yeah, look, alternative assets is a very broad term, but it's real and it's morphed a lot. But really, for us, it's about investing in non-mainstream asset classes, and those non-mainstream asset classes are declining. I mean, private credit, as we've just been discussing, is becoming much more mainstream. But certainly we focus on providing alternative sources of income and returns for our investors. That's been the history of the business, and that's been done outside of public markets. In terms of the business itself, as I said, our foundational asset class has been real estate private credit. But we're continuing to diversify the business. In December 2023, we launched a US private credit strategy, which I'm happy to talk a little more about. That's certainly an attractive market, and we'll continue to respond to the demand that we have from our 100,000 odd investors and around about 4,000 financial advisors who support our business and invest through La Trobe. We've had so much demand from them asking, what else can you do for us? And so, we're really embracing that and trying to respond to that demand by diversifying into other asset classes to support the business.
I was just looking, David, this is a quick fact about the 12-month term account. So maybe I'll get you to explain what that is in just a moment. But I was looking at this just now. It's got $9.5 billion in it from what I can see at the end of 2024. 32,000 investors or thereabouts. That's like you mentioned off air that you've got a lot of the investors who come to you are like quote unquote retail investors like myself on the street, right? I come to you and I have a need and you fulfill that. That's very unique for a lot of people that listen to the show, probably aren't aware of the context of that. That is very, very unique. Can you just take a moment just to explain what this 12-month term account is? I know that's a bit of a product thing, but I'm just curious. Yeah.
Sure. The 12-month term account is our flagship product. It is $9.5 billion of the, we're sneaking up on $13 billion now across the credit fund universe, which has 7 products within it. But said the 12-month term account is the bulk of that. It's providing access to for our investors to the assets we originate on our credit side. So it's really a very widely diversified pool of assets. So in that there's around about 9,900 individual loans within that portfolio. So it's hugely diversified. And that's really, I think, the secret sauce for us as a business. We invest in quality assets. We have a really large team of people assessing credit on a daily basis. And we do that not through algorithms, but we do have automated systems. But, there are people behind each and every credit decision that we make. And we're originating those loans, as I said, on a daily basis and offering them to our investors to take advantage of that. We have quality assets. We always widely diversify and we always build in a margin of safety. And that's stood our investors in very good stead over 30-odd years of our credit fund.
Well, 30 years, yeah. We were just chatting off air and saying it's like a lot of these strategies for people that aren't familiar, like a lot of people in the share market and buying, say, like technology companies or whatever their whatever floats their boat, they tend to be high conviction. They pride themselves, a lot of active fund managers pride themselves in that. But when it comes to private credit, it's kind of like, well, we've got to diversify. We want to be like, an inch deep, mile wide, which is really, of course, there are different strategies for different things. But I'm looking at this here and it's got the current variable rate effective as of 1 November 2024. So just keep that in mind, everyone that's listening. But 6.75% per annum, people would see that as effectively like an extension of like their TDs or like term deposits or like taking more risk, but not substantially more for that increased 1 or 2% return, which to them would mean a lot, particularly in this environment. I'd like to zoom back around to more of the private credit side, just writ large. One of the things that I've had a few calls lately with some of our investors in our community, David, and a lot of them, particularly the retirees and going on retirees or early retirees, love this type of product and love the private credit universe because they can start to take, like I said, incrementally a little bit more risk. They're still diversified, but they get that extra return it provides for their lifestyle. But one of the fears that a lot of them have is that this private credit thing has been talked about a lot in the media. There's podcasts like you and I today doing this, whereas 4 years ago we weren't really doing them, these types of things. And a lot of people have become fearful that maybe this is, it's a bit hyped up, it's a bit in a bubble. It's like all these phrases that people would use. How do you respond to something like that?
Yeah, look, it's a really good point. And probably just to go back to some fundamentals for a moment. I mean, credit portfolios, as you said, are different to equity portfolios. In credit, you get your income and if you do it right, you get your money back at the end of the term, or it amortizes down over time depending on the type of credit. And so you need to diversify widely because you're not really diluting your upside, if you know what I mean. Whereas in an equity portfolio, you can, many would say you can over diversify. And so you end up getting paying active fees to get passive type returns. So that's a really important point, I think, for listeners to keep in mind, that that wide diversification is important in private credit. But coming back to the risks, I think you always see people and organisations at the top of the market stretching what they do. That might be paying just that little bit more for an asset than they might normally, or just relaxing their terms a little bit to capture that little extra bit of return. That's usually a sign of things might be getting a bit frothy. Now, we're not seeing that in our fundamental asset class. For example, the arrears that we see in our portfolio are very much within the long-term average ranges. And we don't change our parameters. We're very strict around our credit control, again, making sure we get back to those three key areas of widely diversified in quality assets with a margin of safety. And as long as you stick to your parameters and your underwriting requirements, I think there is still plenty of opportunity for investors.
I think that's a really good answer, particularly the first part there, Dave, where you said that a lot of the times when people do over-diversify, quote unquote, they do take away some of that upside potential because they feel like they're not as concentrated on their best ideas, quote unquote. But in credit, we kind of have the market and we know what the market is. It's then how do we control to the downside, not to the upside? And I think that's that inversion is sometimes difficult for equity or share investors to get their head around. But once you do, you can see that come to life. And I was talking to you about some of our community members do like to go into this market just 1v1, so to speak. They're in there and they're trying to lend to either businesses or property development or something like this. And they quote returns and they ask me about it. And I say, well, to be honest, that's probably... I don't know. I think there's a professional for this and you should be using a professional because the key thing is that diversification, margin of safety, but also deal flow, right?
Yeah, look, absolutely. It's really important to make sure that you're not scrambling for assets, that you have choice. And we obviously do that every day. We're selective about the assets that we underwrite and that we bring into the portfolio. And we're also very careful around how we construct the portfolios to make sure that we have the right levels of liquidity and diversification. So that's critical. And that's sometimes quite intensive in terms of the work you need to do. So it is important, if people are considering doing that themselves, that they do their research and understand that there is a lot of work to be done to get good quality assets and a diversified pool.
So say, for example, so I would advocate for anyone basically, unless you're a professional investor, to go through a fund manager for this part of their portfolio because of all the reasons you mentioned. And we were talking off air about private markets being about basically having a seat at the table, basically having the connections, because a lot of it is relationship driven in that, I have a need, for example, recently in our business where I needed this corporate note and I knew the people that gave us that money, right? If I didn't know the people, there's no way I would have got it. So it's a different type of investment universe, and that's where having those networks and the connections and the reputation is really important. If I'm a listener and I'm thinking about this, okay, this David guy, Trobe, sounds all really good. I like the idea of just kind of putting an extra layer of income into my portfolio. What advice would you have to them to study the strategies or study the funds or products just generally? Like, what are the metrics? What are the things that you would think about? Or if you were telling, your partner to say, hey, now you've read the book, now you want to study some managers. Here are the 2 or 3, the 5 criteria. However you think about it, just generally speaking, what are the kind of the points that you would want to hit?
Yeah, that's a big question.
Yeah, it is.
Look, in terms of the key metrics, there are a lot of the things that you would expect to consider. What is the asset that you're lending against, or the business and the cash flow and the metrics you're lending against, and how is it secured? So if something does go wrong, are you looking to, potentially recover from those assets in deep, liquid, diversified markets? So that's the first thing, looking to make sure that you understand what it is you're lending against and what protections you have. And then things, again, like not overextending. What is the loan to valuation ratio? If you're lending at 95%, then clearly that's a lot riskier than lending at 60 or 70%. And that's where that margin of safety comes in. But also looking at diversification and how many loans are in the portfolio. Are they geographically diversified? Are they diversified by industry? And are they diversified by borrower type? They're some of the key metrics, which hopefully would make sense to most people that are doing investing themselves. But it does take work to do that. And for those that are interested, I would encourage them to go on our website and have a look. Each month we publish a report called our Snapshot of Metrics.
Yep.
And that provides a huge level of transparency. And our investors and advisors tell us that it's market leading in terms of the level of transparency that we provide. And I think you were just Googling and looking before, and you can see very granular detail around the number of loans that are in the portfolio, the weighted loan to value ratio, the types of borrowers that are in there, the interest rates, and that we've loaned at, and also the seasoning of those loans. So when those loans have been originated, just as examples. But there's 5 pages of data there that investors can trawl through.
Wow. And
I think when looking for a fund manager, that's one of the things that I would say to people, is it a strong team? Do they have a track record that they can point to, ideally over a longer term than, hey, we did really well last month, and really looking for that experience and transparency. What are you prepared to tell us about the strategy and how it's done, and how often are we going to get detailed analysis on where you've put our funds?
That's such a good thing. I've wrote that down. I'll put a link in the show notes to that, as well as the 12-month term account, but also some of like the US private credit fund. And a bunch of the other things that I found really interesting when I was reading through the literature on the website, because I have this kind of feeling or this curiosity, we'll say, David, where I love to find asset classes, markets, products, things that not necessarily are in that phase of everyone's talking about it kind of thing, but to see where like the market is shifting. Like I think about, say like realestate.com.au with like residential property, like 2000s, we all used to remember picking up those local real estate agent pamphlets that would have all the property listings in an area. You flip to the back, there might be like some mortgagee sales or something like that. And that's how you would find, like through the opacity of the industry, there wasn't one centralized database where all of the good deals went, right? So you would flick through these little pamphlets and you would find the properties that you want to buy or the good deals on different streets that you didn't know existed. And I think about what websites and platforms like realestate.com.au or, Twilio, or sorry, not Twilio, like in the US, like Realtor, those types of websites and platforms. And even here in Australia, stock markets, brokerage accounts, they kind of shine a light of all these things. But oftentimes you don't want to be researching when that happens. You want to be in there before that. And so I think with private credit coming to the fore for a lot of people, this is a now opportunity for our investors to go and to read and to learn and discover this because the fruits are there, in my opinion. And so this is really, really interesting stuff. One of the things that Trobe talks about is being boring, which surprisingly is very, well received in our community. What does that mean?
Oh, look, I think we take a very simple approach to what we do. And it, again, I'm probably going to bore the listeners by saying it comes back to those 3 key principles of making sure that, we're investing in quality assets. We're making sure that we have wide diversification in our portfolios, and we do make sure we have a margin of safety in anything that we're extending. And that's key. And if I reflect on our US private credit strategy, for example, we partner with Morgan Stanley in the US on that strategy. And their direct lending team in New York, not only is it a big team, it's a very experienced team. But again, like the power of Latrobe with our very big team on the ground, the Morgan Stanley network provides them with a huge amount of deal flow. They look at a huge amount of opportunities. They're not going through the back of the paper near the obituaries looking for mortgagee and possession assets. And so they have that ability to be very selective and choose, and they can build a portfolio from a very wide range. And similarly with our US private credit strategy, for those listeners that are interested and want to understand the metrics, we have a similar report that we make available on our website there for anyone interested in that. Again, you can dive into some of the key metrics of that direct lending, which is different to our domestic strategy. It's direct lending into middle market corporates in the US, which incidentally is a hugely deep market.
Yeah, it is. Yeah.
So there's plenty of detail there that you can get a good understanding of what's in the portfolio and how it's done and how it's performing.
I think in terms of the risk reward, understanding brand value, one of the things that people would probably find a lot of comfort in is this idea that having never missed a distribution. So tell us a little bit about that.
Yeah, look, that's something that obviously we pride ourselves on. We've never missed a distribution. We've never passed on a credit loss to our investors. And again, that comes down to that really granular underwriting. You know, a lot of loans, need that little bit of extra assessment. When we think about our borrowers in our domestic real estate private credit, they're high quality borrowers, but there might be something just a little bit different about them that doesn't fit a standard algorithm. A great example that we often talk about is surgeons who might be working in a hospital. Really high incomes, generally a great credit. But because their income can be quite variable, a standard underwriting algorithm will say, that's a bit too risky, really variable income. But for us, if we do the work and we understand what we're lending against, they're generally, very reliable borrowers. And so making sure that we really use that sort of common sense overlay whenever we're doing our underwriting work. We have a very structured process, but we put that common sense lens on it, which an algorithm can't do. That really allows us to be very selective and get high quality borrowers. But when you've diversified in the 12 months term account with 9,900 and I think 58 loans it was at the December mark, then you've got wide diversification. And with the margin of safety, we maintain a weighted average loan to value ratio in the 12-month term account, which is around 63%. Okay. So quite conservative. And that allows us, we do also maintain an investor reserve within the strategy. And that ranges typically between 30 and 60 basis points, which is an additional protection for investors. So with all of those things working for us, that allows us to deliver to our investors on time, in full, and pay redemptions as and when they're needed.
This might be a question for your marketing team, so apologies, David, but I'm assuming I can jump on the website. I haven't done this yet, I must admit, but I'm assuming I could jump on the website and subscribe to newsletters and these types of things and stay in the loop as things come out and the team are publishing material. Yes,
that we do. We produce regular newsletters and monthly reporting on all the strategies. So there's plenty of information available for those that want to dive into the detail.
Yeah, I've got all the links that we've mentioned so far. I try and, for the listeners' benefit or for viewers' benefit, I keep a running list as you say these things that I haven't already put in my notes, I'll add because there's particularly with this, there's going to be a lot of people that are really interested in exploring these in more detail. I'm sure many of our listeners have seen like sponsorships and advertising around. Trobe is very active, as you said. It's like an investor first firm in the finance world, which is great. Can I ask one more question on the US private credit, and maybe we could juxtapose it to any of the other strategies? Is how do you see that? Like, why is that an area of focus when there are other things like available to investors? Like, why would an investor? Maybe I'm already invested with the Trobe, right? Maybe I'm in an account and I'm thinking, well, this private credit thing sounds quite interesting. Why? What are the similarities or differences? Or like, what makes that attractive?
Yeah, look, it's a really good question. The US economy, as everyone would know, is the largest economy in the world. But there's probably one thing that people aren't quite as aware of. We lend through our partnership with Morgan Stanley, we're making loans to what we call the US middle market. So companies that have EBITDA between 25 million and 1 billion. Now, if you look at that slice of the market, there's over 200,000 businesses in that market. It represents 40% of US GDP, and about a third of all jobs in America are employed through those middle market companies. So in its own right, it's the third largest economy in the world, that US middle market. It's interesting because one of the few areas where there's been bipartisan support in the US, and if you follow US politics, there aren't many of those. There's bipartisan support to really grow that middle American business, and that is, reshoring manufacturing, reshoring supply chains through the Inflation Reduction Act as well, supporting the growth of American business and American jobs. So we think it's a huge and deep market, but with really attractive returns. There's as I said, so many deals coming across Morgan Stanley's direct lending team every day that they can be highly selective. It's investing into non-cyclical industries typically, avoiding things like, the restaurants and energy, for example, those industries that tend to be a little more cyclical. So investing in much more solid through the cycle businesses, very predictable, and it's providing returns at 9%. So really quite attractive, and again diversified across, I think now 29 different industries, around about 100 different corporate loans in the portfolio, and again conservative, loan to value ratios in that portfolio.
That's really interesting. I've never heard someone slice it like that and say that's equivalent to like the third largest economy. That gives people a really good sense of just how big it is. But also for people that are listening and they probably heard someone pull out some facts or figures, like the number of companies on the stock exchange are declining. There's all the weighting is going to these mega companies here in Australia and abroad. But there's this whole universe outside of everything that you see there. And that is kind of what we're talking about here is don't just limit yourself to what you see in front of you. Look at all the opportunities. And now you can do that, which is really, really exciting for a lot of people. Obviously, approach it and be cautious. There's, like on the Trobe website here, I can see it right in front of me, product disclosure statements, all the legal documents. If you're unsure, obviously speak to your financial advisor, of course. David, one of the questions I put to everyone that comes on the show for the first time is more philosophical in nature, and it kind of loops us back to the beginning where we talked about your lessons learned and the way you think about investing yourself, is if you could go back in time and maybe tweak one thing, change one thing, tell yourself something. It could be about investing, it could be about finance, it could be about private credit, it could be about literally anything. What would it be?
Yeah, look, it's a really good one, and this is not advice by any stretch, but I think if I reflect back, I would probably say, and certainly I've got 4 kids, I would be saying to them, if you're going to take a little bit more risk, do it early where you've got a very long time frame to manage over. That's probably something that on reflection, maybe I could have taken a little bit more risk very early on in my personal investing career. And that's something that, I talk to the kids about. I can't really get any of them all that interested in finance, unfortunately. I did have one of the kids, just as an aside, come and do work experience, and one of my team, not at La Trobe, I might say, but elsewhere, and one of my team came back and said, I think I won't say his name, but yeah, he's asleep at the desk. He looks really bored. I thought, no, none of them are going to follow me into finance. But I think if you're going to take risk, obviously be very careful and do your homework, but take it a little bit earlier in the investing journey, where there's plenty of time for that slightly growthier investment to play out.
I think that I love that advice, David, because it's kind of like take calculated risk and take it, be aware of that. And I couldn't agree more with you there. Maybe your kids just need to be sent a podcast, a Rask podcast, mate. We've got a lot of kids and adult and teenagers that listens to our various shows. But this has been an absolute delight to sit down and chat with you. So I really appreciate you taking the time out to join me in the studio.
Thanks a lot, Owen. It was fun.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.